the combination of this hitting the precious metals derivatives markets at this time and central banks like the Fed and the Bank of England accelerating their money printing to an extraordinary degree can only have one result, and that is to create a huge, great scarcity of physical metal because people will want it. I mean, it is as simple as that. There is absolutely no currency at all which is completely independent of the dollar. The dollar is the reserve currency. It is the currency in which we all buy our commodities. It is the currency in which we do cross-border sales. More than any other currency, we depend on the dollar. And if the dollar goes, we all go.
This is Dunnigan Kaiser, founder of Liberty and Finance. I'm now a licensed gold and silver broker for Miles Franklin. Call me directly for the physical gold and silver that you need at the best price with personalized private service from one of the oldest and best companies in the business. For fastest service, just call 1-888-81-LIBERTY. That's 888-81-LIBERTY. And either I or one of my sons and fellow brokers will call you back as soon as we can and understand your needs. Welcome back to Liberty and Finance. We have a returning guest. Alasdair MacLeod is the head of research at goldmoney.com, and he joins us again this Thursday, June 24th, 2021. Alasdair, as always, on behalf of our audience, thanks for joining us on Liberty and Finance.
That's very much my pleasure, DK.
People don't know, some, that you were a bank president, that you've been involved for across a span of 5 decades in banking, equity trading, precious metals, that you have an insider's insight and connections and relationships and history that go way back in this industry, and that you look at it from that vantage point. So we do well always to heed your perspectives, and we're grateful for your presence here always with us. Right now, we're on the eve almost. It's early next week is coming up on June 28th, the first implementation of some important net stable funding regulations for the Basel III Accord, which I've just said words that I know nothing about. So I know you've demystified that to some extent on our channel. You've also appeared recently on As Good as Gold Australia, explaining it in greater depth. In a nutshell, one of the things that we took away from our last talk with you about that was that you expect this to be essentially or functionally the end of the kind of free hand that bullion banks have had in using shorting or futures to basically take part in pricing action, and that will have to be an end to that. There's great interest because there are vital interests of stakeholders, including ordinary investors as well as mining companies and so on, that are very, very interested in whether that is in fact the result that will play out from this rule taking effect. And there's even question of whether the rule would even take effect, or if there's be some last minute deus ex machina that's going to say, oh, just kidding, and on with business as usual. So first off, do we have reason to believe that this will actually take effect, number one? Number two, that if it does affect it, that the impact of it will be as dramatic as you suggest? Let's start there.
Okay. It will have an effect. I think you have to bear in mind that this isn't just the Bank of International Settlements, Basel III, attacking gold and silver markets. This covers everything that a bank does. It looks at both sides of a bank's balance sheet, its liabilities and its assets. And what it does is through this new device called a net stable funding ratio, it ensures that essentially long-term finance backs long-term assets. Short-term finance is not used to back anything other than certain short-term assets. So the idea behind this is that we're not going to get a systemic run, if you like, or the domino effect between banks, one bank going under and then suddenly all the other banks going under, because they have a mismatch between their funding and their assets. So this is a very, very big deal. It really is. You have to bear in mind that the wording on the net stable funding requirement in Basel III was agreed back in October 2014. So this is a long time ago. I mean, seven years ago now, nearly 7 years. It has been delayed. The introduction has been delayed for various reasons. We needn't go into that. All I would say is that if this had been introduced in 2014, before this massive increase in monetary inflation, the impact probably would have been less than potentially it is now that it is introduced after both the Fed and the Bank of England in particular have expanded their balance sheets by almost 800% from 2007. And other central banks like the ECB and the Bank of Japan have also expanded their balance sheets, not quite so much. It doesn't really affect China in the sense that the Chinese have not expanded their central bank balance sheet by very much compared with everybody else. It's only about 125% or something. Whereas if you're looking at the Fed and you're looking at the Bank of England, we're talking very nearly 800% expansion of the balance sheet. We take that, if you like, as an indication of the amount of monetary inflation that has been injected into the economy, all through special measures of one sort or another. I mean, QE and so on and so forth. And if you really thought that this was going to end with the Lehman crisis, once that was resolved, as it were, then, I mean, my goodness, how naive. I mean, with these tools, the central banks, when they found that they could get away with it first time, what happened? They've deployed it again in far greater quantity. Anyway, the burden of my song is that if this had been introduced in 2014, I think the impact would have been potentially less than it is likely to be now that it is introduced in 2021. So what actually is it? I mean, we're talking the net stable funding requirement is the available stable funding, which is applied to the liability side of a bank's balance sheet, divided by the required stable funding, and it must always exceed 1. So the available stable funding, what's that? It looks at various categories of bank liability. Now, the most stable form of bank liability, which can be used to fund anything, obviously, is primary capital. The capital that can't be taken out by the banks, the particularly equity capital, the equity shareholders' interest in the bank. That is a liability on the bank's balance sheet, but it's not something that's going to be reduced ever. So that can be used for funding everything. You then go through things like small deposits. Now, it is assumed that small deposits, for a start, they're guaranteed by various schemes in different countries. I mean, in the United States, I think it's $125,000 or $250,000 or something. Yeah, so they're guaranteed. That's fine. So you can use something like 90% of those deposits, which are bank liabilities, to fund the asset side of a balance sheet. Okay, so. And when you look at corporate deposits, because corporate deposits are larger, not covered by these government guarantees or banking system guarantees, and have the ability to just disappear like that and have a commensurate effect on a bank balance sheet, as in terms of available stable funding, that is less important, if you like. That provides less stable funding. So there's a factor put on that of, say, something like 50%. So you can only use half large company deposits to fund the assets on the other side of your balance sheet. And then we come to gold. Now, gold liabilities are quite simply paper liabilities. I mean, they are not physical gold. If you deposit physical gold with a bank, you've got two ways of doing it. Either it goes on its balance sheet, in which case you've got no right to the gold at all. It's wound up tough. You're a creditor. And of course, there is also physical gold, which you might instruct your bank to hold on your behalf as custodian for your gold. Now, that does not appear on the bank's balance sheet. So we're not talking about physical gold. We're talking about unallocated gold, which is a paper substitute for gold. It's quite simple. under the available stable funding calculation, you cannot use any of that to fund the other side of your balance sheet, to fund the assets. So this, you can see that as far as the Treasury Department of your bank is concerned, having liabilities to customers of gold or silver or whatever, even though they're unallocated, because you can't use them to fund anything on the other side of your balance sheet, this is not something that you really want to encourage, because you want to have funds which you can actually apply your assets. Okay, so that's the important thing, and I think this has been missed actually by quite a lot of people, including the LBMA in their complaining letter to our regulator. On the asset side of the balance sheet, you've then got required stable funding, and again, it depends what the asset is. If, let us say, the asset is a long-term asset which the bank doesn't have to liquidate for a year, if it's on the balance sheet and it's there for a year at least, sort of thing, then under those circumstances, that's fine. I've no problem at all. If, on the other hand, you've got something like gold, let's say, and again, we're looking unallocated, a bank can own physical gold in its own right, but that's a different class of asset. We're talking about the unallocated, and we're talking about derivatives and so on. Now, you can cover that. I mean, if that's, say, worth $100 million on your balance sheet, then the available stable funding that you must allocate to it is $85 million. 85% of it has to be covered by available stable funding. So this is the way it works. It means that, in effect, there is something of a haircut, if you like, between both sides of the balance sheet. But it's worse than just the 15% difference, because you cannot, if you've got a gold position on the liabilities side, you cannot use it to fund a gold position on the other side. Now, I think there is an element of interpretation in this, insofar as different regulators might look at this slightly differently. So if, let us say, you have a specific position on one side of the balance sheet against a specific position on the other side of the balance sheet, then you can probably net them off. And there are various rules within derivatives which basically allow this to happen. So that's fine. We don't actually know the detail as to how this is going to work, because there is a small amount of interpretation. But quite clearly, for the Treasury Department in a bank to have banking business, which is effectively inefficient from the Treasurer's point of view, is something that he's not going to really sanction, because he's interested in maximizing the return for the shareholders, if you like, the primary form of liability on the balance sheet. So, what's going to happen is that you will find that bullion banks in the bullion business, in the unallocated bullion business, are likely to withdraw from that business. I mean, they can continue, but they would have to accept the penalties of being in the business through Basel III. So, it's not necessarily the complete end of unallocated gold forwards in London and gold futures on COMEX. But I tell you what, bank chairmen are going to need a hell of a lot of persuading to continue those activities. And under advice from their Treasury departments, they're likely to withdraw from it. And the other thing is that in London, with the with the settlement system of the unallocated gold, which is run by, I think, 4 of the largest banks. The London, I can't remember quite what it's called, it's got a series of initials, but basically you've got this centralized settlement system operated by the largest banks. For them to operate that is disadvantageous for their balance sheet. So it's quite likely that 4 will become 3 or will become 2, and they can't get anyone to replace them. So you can see that this is a very serious issue. And indeed, the LBMA, in its complaint to the PRA about, why are we being included in this sort of thing, they pointed out that this basically is going to close down the market. So it's not just me saying it, it's them saying it as well. So the letter is available. I mean, if you go onto the LBMA website, and you'll find it. It's a joint letter written by them and the World Gold Council. And quite honestly, I think the World Gold Council knows very little about this. I mean, quite why they got themselves involved. I think it's sort of solidarity, if you like, with London. But this is coming, as I say, at a really rather bad time. Now, the important implication is that you will find that liquidity in gold derivatives is obviously going to decline very seriously with these banks going out. I mean, they're not the only market makers, if you like, in the market, but they are substantially the market makers in the market. So when they withdraw, you will find that the liquidity is going to diminish very significantly. Now, this leads to greater volatility. I mean, both ways. But the other thing we have to consider is the position of the bullion bank's customers in London, who will find that they don't have any exposure to gold at all now, as these banks withdraw. So in the coming months, and incidentally, I should say that London will be introducing these rules not from the 1st of next month, but from the end of this year. So we've got a sort of 6-month grace, as it were, for the LBMA and others to get their act together. The customers of these banks will find that they no longer have the facility. Now, I'm sure that a number of them will just sort of pack up and say, well, it's fun while it lasted. We've been paid off. The account's closed. We'll go and do other things. But I think given that the rate of monetary inflation has just taken off into hyperspace recently, I think it is very likely that quite a number or quite a large proportion of customers with unallocated accounts are going to seek to replace them with custodial gold, I mean the physical. And that would put a huge strain on the market because there is not a lot of liquidity in the market. We have no idea, incidentally, how large this problem is. I mean, all we can do is a little bit of guesstimating. The London Bullion Market Association says that its members, and we're talking about settlements between its members through the settlement system, around about 30 million ounces a day. Now, this doesn't cover transactions intraday. This is just, at the end of the day, 30 million ounces have changed hands. 30 million ounces of paper have changed hands. The situation with LBMA banking clients is not covered in this at all, because this is only deals between LBMA members. So we don't know what the situation is with clients. But if you go way back, they did actually report, the LBMA did report estimates as to how much client business was transacted as well. And in very rough terms, I think if we sort of pencil in something like 5 times that 30 million ounces, we're probably not too far from, roughly where it is. So if we're looking at a daily turnover with non-members of about 150 million ounces, that gives you a scale of, if say, I don't know, 10, 20% of those decide that they want to continue to have gold exposure and go for physical, then obviously you can see this is going to have a major impact on the market. I mean, we don't know until it happens. But what I would say is that the combination of this hitting the precious metals derivatives markets at this time and central banks like the Fed and the Bank of England accelerating their money printing to an extraordinary degree can only have one result, and that is to create a huge, great scarcity of physical metal because people will want it. I mean, it is as simple as that. I think it is important to understand that it's the two things happening together which are likely to cause the effect. And so I think just to look at it in terms of net stable funding requirement means this, means that. Yeah, fine. I mean, on the face of it, you could argue that all it does is it's by cutting out the market or reducing the size of the market, it's just going to make things more volatile. It means one way or the other, sure. But what a time to do it. What a time to do it.
One of the parts of your thesis there, I think, is that business sense will prevail. The heads of the Treasury departments of the banks will say, "Gents, this is no longer as low risk as it used to be, or it's not as profitable as it used to be. We should curtail this activity." But let me just take the devil's advocate here and say, isn't that perhaps a naive starting point or assumption that we're not living in through the looking glass, so to speak? Because so many people have been claiming for a long time that the behavior of banks in making a market for U.S. Treasuries, for example, when there's no profit to be made or whatever, but that basically they're captive participants because of the backstop of the Fed or the backstop of the Treasury, and they have to do this stuff because they're at the behest of the puppet master, and the banks are just the functionaries who are doing the doing. It doesn't have to make business sense on the front because the backside is so guaranteed, or the backside is so rewarding in ways that's not obvious to the pedestrians on the street. Is it possible, in fact, that they will not withdraw because it doesn't have to make business sense in the way that you're describing at the individual enterprise level, the way a normal business or a normal household has to operate and balance their books and everything, that in fact all rules are off in this wonderful world we live in?
I don't buy that story at all. I mean, for a start, I think two things. Banks actually are independent. Okay, they depend on a license from the government, but they're not going to roll over because the government says do this. They'll say, okay, what's in it for us? Okay, so that's the first thing. The second thing is a slightly sort of different angle which you're coming from. People say, well, how on earth is it that governments permit this to happen when they could have stopped it? And the answer basically is that at the G20 level, they instructed the Bank of International Settlements to come up with this. So they can't now complain, if you like, that the banks are going to be doing things which don't suit the government. I think also that we underestimate perhaps the profitability of dealing in derivatives generally, which is why it's the market has just grown like topsy. I mean, we're back up to something like 700 trillion if you look at the Bank of International Settlement figures, and certainly in precious metals. I mean, the turnover is enormous. They make huge amounts of money, and they make so much money that the loss on the short position, which they run all the time, is something that they can quite easily absorb. I mean, if you look at the average position on COMEX, and COMEX is probably nearly 1/10, or as little as 1/10 of the total derivatives in London and Zurich. But if you look at them, the average short position is around about $1.6 billion. I mean, that's just gold. This is a huge short position. But so profitable is it running these, jobbing against these positions that, so what? I mean, we don't particularly care, say the banks. It's been wonderful. So, but I mean, the point is that it's now got a hurdle to overcome, a greater hurdle to overcome, and that is the Basel III is screwing up the financing of these positions, and that is why this is actually so important. So, I mean, I go all the way back to the stock market when we had single capacity. I mean, we either acted as brokers or we acted as jobbers. And basically, the definition of a jobber was someone who never dealt with a member of the public. He only dealt with other members of the stock exchange. And so I would go to a jobber and I always asked the price in ICI, for example, which in those days was a major company. And he would make a two-way price, and he would tell me how many shares he was prepared to deal in that price. Now, usually when someone goes into the market to inquire about a price, then the odds are that he's a buyer. He can be a seller, yeah, but the odds are he's a buyer. If he's already bought it, then the jobber knows that I'm already long. And so when I ask the price, I might turn out to be a seller. So, with just a little bit of intuition and all the rest of it, plus the spread, jobbing has been a marvelously profitable business. And there's no reason why banks dealing in derivatives, whether it's gold, silver, oil, copper, whatever, similarly find it a very, very profitable business. But the problem now is that the funding of this has been cut out from under the dealers' legs, and that is the problem.
I was thinking earlier when you talked about if any participants withdraw, one effect of that will be to increase the volatility because you'll have a thinner market, more thinly traded market, less liquid. And I thought, well, gee, for these artists who know how to make almost 100% profitable trades in these markets, increased volatility is just a gift because you can just make more with less. But anyway.
Well, that's true. But on the other hand, look at it from this point of view. On COMEX, the relationship between the two non-specs, which are basically the producers and refiners and all the rest of it in one category, and the swaps, which contain all the bullion banks and a few other, if you like, jobbers, as it were. The relationship is that the swaps category is about 75% of the non-specs. So if we're cutting that right down, you can see that if, let us say, a hedge fund decides that it's time to sell dollars, buy gold, then his order in the managed money category is going to have a greater impact on the price. It's bound to. And of course, the other way around. I would fully accept that. And this is why I think just to look at it in terms of, purely from the point of view of the net stable funding requirement, whether it's going to drive prices up or down, I think is the wrong way to look at it. You've got to look at it in combination with what's actually going on in the broader money and market sense.
One follow-up related question from a viewer on this topic. Chris Napolitano says, when Basel III is implemented on the 28th of June, will it change or end the COMEX manipulation? And related to this from the Daily Rant, should we expect major changes in metals from Basel III immediately after the 28th, or will things change slowly over time? You've talked about some major effects that could happen rather significantly, other things that are going to be delayed 6 months with the UK and others. Do you foresee, or would you be the least surprised to see some rather dramatic effects happening in the next month or so, or do you expect whatever does play out will play out over a more extended period of time?
Well, again, I think we've got to look at the net stable funding requirement as a separate issue, if you like, from what's going on in the market. I would suggest, I put myself in the position, if you like, of, a bank chairman or a CEO, looking at the various trading desks that we operate. And I wouldn't tell my dealers, look, you got to, 28th of June, you got to cut, you're shutting down. That's it. No, I'm not going to do that at all. I will watch their progress in terms of withdrawing the bank's liabilities into that market. If the dealers turn around and say, look, we've got some very profitable trades on then, I'm going to listen to them. So this isn't going to be, an immediate bang. What is going to happen, I think, is that over a not very long period of time, you will find that the liquidity in the market will gradually be withdrawn. So I think that is the important point. In terms of what's going to happen to prices, I think that we've almost got to sort of put that to one side and understand what is happening to money. And that, I think, is a far more serious issue. It really Yeah, and so
I wanted to get into that with you if we could. So you recently wrote an article about hyperinflation and its impact on both assets and consumer prices. You've been warning us for quarters about the destruction of the currency, and as you say, it's coming to a fever pitch. And so could you talk to us specifically about what evidence you see, other than, you mentioned expansion of the central bank's balance sheet, but other than that, evidence of hyperinflation emerging, and what you think its impact will be on both assets and consumers?
I think the first thing, and we've talked about this before, the first thing I think is to define the sort of inflation I see. I don't think it's, if you like, rather like the German inflation, where printing money has become a sort of, it's going to continue, and we've got another 4 or 5 years of this just getting deeper and deeper in the hole, and politicians being completely unable to stop printing money as a source of funding for their wonderful plans. That I think is a course which we are probably set on, but we've got a far more important problem, and that is that central banks, led by the Bank of England, funnily enough, and also the Fed from after the Lehman crisis, have gone into extraordinary measures to ensure that financial markets are in a bubble. And I mean, at the moment, the Fed is printing 120 billion a month, going into buying U.S. Treasury debt and also agency debt off the pension funds and off the insurance companies, and telling them, here's the cash, go and invest it in something a bit more risky, like corporate debt or equities. So it's this that's driving the equity market bubble. And the other thing that's interesting, if you look at the FINRA statistics on investor borrowing, it's just gone through the roof. Investors are currently borrowing about $900 billion to, play the market. This is gearing up in a bull market. This is the sort of sentiment that you get at the, what Mackay called the madness of crowds. I mean, it really is. In my recent article, I said that we haven't seen this since our grandfathers were taking advice from lift boys, bellhops, and shoe shine boys. Literally, that is where we are. But they've got a problem, because as far as the central banks are concerned, they've homed in on financial markets, and particularly equity markets, as representing the confidence in the economy. They understand that without that confidence, there is nothing. So it is of supreme importance that they continue to support these markets. Now, this is exactly what John Law did with his Mississippi venture 301 years ago. And we've talked about this, and that collapsed, the bubble collapsed, and it destroyed the currency. The company went on. In fact, Clive of India chucked out the French some 50 years after the John Law experience, chucked him out of India. That was John Law's company. Well, it was his company before he lost it. But so that continued. But guess what? The unbacked livre became completely worthless. The lesson from that is, if you print a fiat currency in order to support a market and to ensure that the market continues at a high valuation, then sooner or later, that scheme of arrangement is going to collapse, and what will be destroyed is the currency. We are on that course, and this is something that I think is going to happen really quite quickly. And the reason it'll happen is that people are now waking up to the fact that there is not the supply of product to satisfy all the consumption, which has been financed out of thin air by the government with this huge, great deficit, helicoptering it to individuals, increasing the unemployment benefit, subsidizing this, subsidizing that, and all the rest of it, all this consumer money has actually got nowhere to go because you've got a combination of consumer prices which have gone through the roof. I mean, they've almost doubled actually since March last year. On top of that, you've got the supply chain disruption, the logistics disruption, which you talk to people in the logistics industry, and the people who know what they're talking about saying this is going to take a year to sort out minimum. So that is still a huge, great problem. And then there's the real surprise. Nobody wants to work. You find that, if you want to make something or expand your production, you can't get anyone to work for you. Why? Because, I mean, it's a mystery. I mean, the answer is something which is really unacceptable to the socialists. And that is that if you pay people not to work, then they're actually going to quite like that lifestyle and they're not going to return to work. And that basically is what's happened. So you've got these three things. You've got the commodity prices through the roof, the logistics foul up, and nobody wanting to work for you. And on top of that, you've got no stock on the shelves. So what happens to prices that go through the roof? The Fed last week tried to tell us, no, it's not a problem. All right, we'll see inflation pick up a little bit, but transient. Don't worry. We're not going to raise interest rates or anything like that. We might, bring them forward a year from, 2060 to 2059 or, sorry, I exaggerate. But you see what they're trying to say, this is not a problem, but it is a problem. And I reckon that by later on in the summer, maybe at the very latest, earliest autumn, there is going to be a dollar crisis. Why? Because interest rates have got to go up. Bear in mind that the foreigners own a total of over $11 trillion in equities, in US equities. And they have got that. Basically, they've made money on the rising market. They've got no reason to be there other than this is profitable. So at the moment it's not profitable. There's $11 trillion of selling likely to happen. A lot of that is going to leave the dollar rather than just go and sit in cash in the, in the banks or go into US treasuries. What's going to trigger that? Well, the answer is quite simple, and that is that you cannot sustain a dollar where there is 31 trillion is the most recent figure, 31 trillion of foreign ownership in the US dollar. You cannot continue with zero interest rates, zero return, a return of 1.5% on a 10-year bond. You cannot continue with that and expect foreigners to hold on to their dollars. No, they're going to sell it. And as the dollar goes down, interest rates have got to go up. And the more the Fed resists this, the worse the situation is going to be. And they will resist it because they have tied themselves in to a perpetual bull market. They have got to ensure that interest rates don't rise. And when push comes to shove, it's not going to be 120 billion. It's going to be the Fed going out and subscribing directly into ETFs to buy the index, to buy the S&P 500 directly. I mean, forget this business of going via pension funds and all the rest of it. And furthermore, 120 billion, try 200 plus. I mean, that is the sort of thing they're going to do. Now, rather than push down interest rates, I mean, okay, that might keep the equity market bubbling a little bit, but the foreigners are going to look at this and say, no, hold on a minute. This is not something that we really want to be part of. And they will sell the dollar. They will sell it in increasing quantities. That is the way the crash is going to happen. And it will take no more than 6 months. I mean, tops. Once it starts, it will take no more than that. The collapse of the currency, it seems to me, if we look at the John Law experience, threatens to be total, absolutely total. If we can switch from the John Law experience to what happened in Germany in just nearly 100 years ago, 1923, then we found that asset prices measured in paper marks obviously rose. But there were two things about this. First of all, they didn't rise as quickly as the expansion of the money supply. And the second thing is that there was sound money. You could transact in dollars. Dollars were exchangeable into gold at the rate of $20.67 an ounce. So, German businesses in the export industry were earning hard currency, even though the domestic currency was collapsing. Now, this created a situation in terms of prices, which we do not have and will not have if we get a complete fiat currency collapse today, because there is absolutely no currency at all which is completely independent of the dollar. Not even the ruble, not even the Chinese yuan. I mean, they can make it independent, but at the moment, the dollar is the reserve currency. It is the currency in which we all buy our commodities. It is the currency in which we do cross-border sales more than any other currency. We depend on the dollar. And if the dollar goes, we all go. There is no firm, sound money substitute. Now, I hope that changes, and I believe it will change, because to have a complete collapse means that there will be no money at all, other than those of us who have got gold and silver in coin form, perhaps, and can use it to exchange it for, if you like, the things we need. I mean, we could buy property, but I mean, think about the valuation of property. That's the interesting one, because people assume that one way in which you can hedge your way out of a collapsing currency is actually to own property. By property, I mean, residential property or commercial property or whatever. But the problem is that while we have had a rate of inflation which hasn't really sort of upset the status quo, and we've been able to hedge that inflation by having ownership of portfolio assets, property, and so on and so forth. And on a sort of personal level, we've all owned our own houses, and we've geared it up through mortgages, and one way or the other, we've managed to do pretty well trying to keep our wealth together at a time of continual depreciation of the purchasing power of the money in which we value all our assets. But that is changing. That changes. When you get a hyperinflation situation, then inevitably property, other than the utility of having a roof over your own head, then becomes a liability, because the rentals that you get on it become worthless very quickly. You cannot keep up to date by increasing your rentals, if you like, to take account of the collapse of the purchasing power of the currency.
If it's not like productive farmland, it would be different, because it's actually producing something of intrinsic value, whereas just a rental apartment or office building or something like that you can only charge fiat rent for is a problem for a landlord. Yeah.
But you've also got another problem, and that is that property needs maintaining. And so, the cost of maintaining it is going to become a far greater liability than any income that you can get from letting the property. So a property becomes, it becomes virtually worthless in a sense. Now, what happened in Germany was, because you had sound money circulating alongside the paper mark, and because you had foreigners with sound money
in the form of gold-backed US dollars.
Gold-backed US dollars, okay. Exactly. They were able to buy property. So, I mean, in a sense, property prices in Germany were higher than they would be in the situation which we're now forced to consider. And I think, again, on your show, I've quoted the situation in Germany, where in Berlin, where you could buy a really decent house in a posh part of Berlin for $100, which was less than 5 ounces of gold. I don't think that in the absence of any sound money at all, in the sense of being available for transactions, I don't even see property holding that sort of value. Why? Because if you've got any property, then you're going to want to try and get rid of it at any price. Firstly, because you don't want the liabilities. And secondly, you've got to raise whatever you can, basically to put food on the table and to keep warm. And it's going to be, unless they actually stop this, and I think they will stop it, but unless they stop it, then this goes to that logical conclusion where we have no money at all, no ability to transact with anyone other than the few lucky people or the few people who have had the prescience to have some gold and silver. But, they're going to part with it easily. And, if with a silver coin, which at the moment is worth what, I don't know, sort of $30 or $40 or something like that, are you going to sort of spend that on things? What are the prices going to be like? I think the prices will probably of consumer goods, and we're talking about essentials. Service industries will just go by the board. But if we're talking about essentials like food, energy, and things like that, then those prices are going to be beyond the reach of the average person. So it's absolutely vital that you have got silver coins, if you like, to be able to continue to buy food and so on and so forth. So, this is potentially a very, very nasty situation. Now, I think what will happen is that at some stage, governments will turn their fiat currency into gold substitutes. They must do that in order to stabilize the currency. They will have to do other things as well. Now, the degree as to whether they're successful or not will depend on their understanding of what they've got to do. And this will cut against socialist principles completely, as you may imagine. But let us assume that the Americans, for example, who are the most important nation in this, actually do stabilize the currency. I mean, they say they've got over 8,000 tons of gold sitting in Fort Knox and wherever. Okay, mobilize that and you can save the world. Now, the rate at which it will probably be mobilized might be several $100,000 an ounce. I don't know, but at least there will be some money which we can then use. And this will leave countries with no gold reserves or have been stupid enough to sell their gold reserves with really quite a dilemma. And how they're going to sort themselves out. I mean, they're just going to have to rely on the flows of money from those that actually have backed their currency in order for their economies to have any chance of recovering at all from this.
And I suppose if they are producers of those vital things, I'm thinking of Canada. Canada is rather famous for having sold off supposedly all of its sovereign gold holdings, but they are big producers of wheat and of other things that the world would also need. So like Russia would or whatever. So interesting. Now, something you mentioned equity markets, you mentioned consumers, you mentioned landlords. Businesses. You did talk about logistical snare-ups, but in a rising silver price environment, Des Phillips asks, what happens to industries that use silver if its price goes substantially higher? Because you just mentioned countries that don't have any gold will be in a hard place. What about industries that need it and don't have it?
Well, I mean, what you'll find is that the uses of silver will change. There will be a far greater usage of silver as a monetary medium than, let's say, as part of solar panels. So it's going to disrupt and make industries like that completely, pointless because it'll be uneconomic. So, this is assuming that governments, if you like, do manage to stabilize things in the manner which I've just described. If they don't, then basically there's no business. It's as simple as that. That's such a, I wouldn't like even to contemplate that. So let us assume that governments do stabilize things. I mean, they will stabilize it very late in the game. I mean, in Germany, they finally stabilized the paper mark at the rate of 1 trillion paper marks to 1 gold mark, 1 trillion to 1. That was, and I was calculating for this last article that I wrote that between April 1923 and November, and this is just taking monthly averages, prices increased by 90 billion times in paper currency. But I think, if I remember correctly, the increase in the quantity of money was around about 61,000 times. So that you can see that the purchasing power of money just collapsed. It wasn't a question of, as monetarists seem to believe, that, you increase the quantity of money and there is this direct relationship between the amount of money in circulation and its purchasing power. No, not at all. It's actually down to whether people accept it or not. And when people actually finally understand that the money is worthless, then it becomes worthless. It doesn't matter how much is in circulation or how much is not in circulation.
So a key takeaway that I'm hearing from you is those who are relying on paper wealth in the equity markets, those who are relying on paper wealth denominated in fiat currencies in bank accounts, deposits, certificates of deposit, that sort of thing, people who are confident that they're protected because they own real estate, meaning like rental units or that sort of commercial real estate, had all better think again through the lens of what do you do in a collapsing currency environment, and what other measures do you need to do to make sure that you're going to have food, shelter, protection, that sort of thing. All right, Alasdair, you've been generous with your time. We're going to have to let you go. There's so many more questions from our viewers, and I think we're just going to have you on more often. But I just am very grateful on behalf of all of our viewers for your presence here. Remind everyone again where they can follow your frequent writings that you put out.
Yep, if you go to goldmoney.com, hit the research tab, I write an insight article which is published every Thursday afternoon. So the one we've just been talking about was published today. That's hot off the press. And I write a market report which is published on Friday afternoons EST. And that's on gold and silver, as it were. But the main sort of education, as it were, is really the insight articles that I write every Thursday.
Well, we're always grateful for your presence here. And folks, if you don't want to miss a single interview with Alasdair or any of our guests, make sure you sign up for our free newsletter. We've got over 57,000 subscribers on YouTube, but only 2,000 subscribers to our newsletter so far. That's a lot of our viewers who don't get informed through that free method. Just go to libertyandfinance.com. That's our homepage, libertyandfinance.com. Put in your name, email address, click submit. You'll get a confirmation email. Make sure you respond to that so you're opted in. You'll get our free newsletter every day with our latest interviews with all our guests, including any links to the resources that they provide. Alasdair, as always, thank you for joining us here on Liberty and Finance.
That's very much my pleasure, DK.
This is Dunnigan Kaiser, founder of Liberty and Finance. I'm now a licensed gold and silver broker for Miles Franklin. Call me directly for the physical gold and silver that you need at the best price with personalized private service from one of the oldest and best companies in the business. 31 years strong, A+ rated by the Better Business Bureau, 0 complaints, licensed and bonded. For physical delivery, vault storage, or precious metals IRAs, excellent prices, privacy, and confidentiality. Pay by check, money order, ACH, bank wire, or Bitcoin. Satisfaction guaranteed. For fastest service, just call 1-888-81-LIBERTY. That's 888-81-LIBERTY. And either I or one of my sons and fellow brokers will call you back as soon as we can and understand your needs.